Let's talk about dependence for a little bit. Dependency is an adjustment for your taxes when you're providing support to other human beings, right? So the idea is the reason we care about dependence because they change the amount of tax you pay, and that's intended to adjust for your ability to pay, right? So single parent with 3 children versus a single taxpayer with no children, there's no doubt they have a different cost structure just to live. And so the tax code builds in an adjustment for that. Now, we could have an argument about whether it should or shouldn't, but let's just roll with it does, because it does. So Bill's 21 single, waits the bar at Hard Rock, $7.50 an hour plus tips. Julie's a single mom, 3 kids, works as Flo's Diner, $7.50 an hour for tips. So these dependencies used to create what's called exemptions. And you used to just get, like, for every dependent you had on your tax return, you would deduct $4,000 from your income, just flat out. It's about $4,000. It was one of those things that was adjusted every year. Those are gone. Those were eliminated as part of the Tax Act in 2017. So dependencies are gone. They'll potentially return in 2026. We'll see. What happened is instead there was an adjustment to the child tax credit. And of course, everyone got lower rates. So now they're a little bit buried inside the standard deduction. The standard deductions used to be much more modest. You would argue now they're a little bit bigger, although they don't count the number of children that you have. So if you used to be, you'd get, like, think of it like a $4,000 exemption and a $4,000 standard deduction if you were single. Now you get a $13,000 standard deduction and no exemption. Julie, as a head of household, she gets that larger amount. And although exemptions are gone, dependency is still very relevant because first off, it can affect filing status. So that's mostly between single and head of household. And we saw from the standard deduction amounts and the tax tables that head of household tends to be a more favorable filing status over single. Doesn't really relate to married filing jointly. For the earned income tax credit, there's a definite benefit. We'll talk about those credits later on in the course. Same with the child tax credit. We'll actually cover that today. So there's 2 ways to be a dependent. You can be a qualifying child or you can be a qualifying relative. And what's really funny about these is to be a qualifying child, you actually don't have to be a child. And to be a qualifying relative, you actually don't have to be a relative. You are required to have a tax ID number. It doesn't have to be a Social Security number, but you must get a tax ID number for anyone you're claiming as a dependent. So let's talk about the qualified child. You have to meet 6 tests. The first is the relationship test. So you have to be a child, a stepchild, an adopted child, or a brother or a sister, a half-brother or half-sister, a step-sibling, or a descendant of any of those. So, for example, a niece or a nephew could qualify as a qualified child. So again, doesn't have to be, we're all children of someone, but it doesn't have to be your child. Foster children can qualify under certain circumstances, and the child must be younger than the person claiming him or her, unless that child is permanently disabled. The second test is sometimes called the domicile test. I don't like that term. I prefer the abode test. I believe the book we're using uses the abode test, which is great. The child must have the same principal place of abode as the taxpayer for more than half of the taxable year. So that child needs to live, and we refer to it as child. Of course, it doesn't have to be, but needs to live in your house for half the taxable year. Temporary absences due to illness, education, and vacation, those don't count. So, for example, if I have a child who's in college and they're away living in the dorms for 8 months of the year, that's still considered a temporary absence. They don't have to live in the dorm. They could live in an apartment, but they're there for college. That's still considered a temporary absence, and I would count those as days they lived in my abode. The age test is they must be under age 19 or a full-time student and under the age of 24. You're considered a full-time student if you're enrolled for at least 5 months of the year. So that means a college senior who graduates in May can qualify in the year of graduation if they're going off to college, or if they're not going off to college, if that makes any sense. So you can see there are age restrictions, right? You can't claim a dependent if your child's 28 years old, even if they're not working. So these rules, that rule in particular is broken down. We'll see in the qualified relative, because there's a chance you could claim them as a qualified relative if they're disabled. Frankly, if they're not disabled, you probably still could. Okay. Joint return test. The child cannot be filing their own joint return. So if your child is married and they're filing a joint return with his or her spouse, technically you're not allowed to claim them. But if the only reason they're filing is to claim a refund of tax, then they're not considered to have filed a return. So really that test is, does that married couple meet the threshold and they're required to file? Because a lot of people may not meet the filing threshold, but they file anyway because they want to get a refund. So the point is, you could in fact claim the child if the only reason they're filing that married filing joint return is that they're trying to get their money back. The citizenship test for a qualifying child must be a U.S. citizen, resident of the U.S., so that's a tax resident. That doesn't mean they're just residing here. They have to be a tax resident. We're not going to dig in on those rules too much, but if you're doing VITA, you will learn about that a lot. They could be a resident of Canada or Mexico and still qualify, or an alien child, so that means a foreign child that's adopted by and living with a U.S. citizen. The self-support test is the last one, and we'll see the support tests for qualifying child and relative are a little bit different. So this is the child provides more than 1/2 of their own support. That doesn't mean actually you have to provide more than half of their support. You could provide 30% of their support, and maybe you're divorced and your previous spouse, your ex-spouse, provides the other 30% of their support. You guys could figure out who's going to claim the child, but the child doesn't provide over half of their own support. So the definition of support: food, lodging, clothes, you would expect all those, medical and dental care, education. Usually you use the actual cost of those, except for lodging, because if you own a home, excuse me, I'm yawning at my own qualifying child definitions. If you own a home, it's hard to determine what the proportionate cost of that might be to care. So you just estimate fair rental value. Funds received by students as scholarships are excluded from the support test. So if part of their self-support is that they got a scholarship, you don't have to include that in their count of their own support. A qualifying relative, again, this is the second way you could qualify, 5 tests. Relationship or member of household tests. So they must be a relative or a member of the household. So qualifying relatives is broad: parents, grandparents, children, grandchildren, siblings, aunts, uncles by blood, nephews and nieces, in-laws, and adopted children. Foster children may also qualify. But again, you don't have to be a relative. You could just be a member of the household. So that's someone who just lives with you. So, my brother's kid, well, that could be a qualifying child. So my friend's child lives with us year round because my friend's a total flake. Can't pay for him, got a drug addiction, who knows what the problems are. So they live with me, I provide their support, et cetera, et cetera, et cetera. There's some chance that I would be able to claim that person as a qualifying relative. There is a gross income test. So this is the individual can't have gross income equal to or above the exemption amount. The exemption amount, even though there aren't exemptions, that we continue to have the exemption amount, that's $4,300 in 2021. So if that person that's a qualifying relative has gross income of more than $4,300 in 2021, you can't claim them. The support test sounds the same, right? Must receive over half or support from the taxpayer. So notice that that's flipped the other direction. So it's a little bit of a mirror. In this case, you must be providing the support, or a group of taxpayers with a multiple support agreement. Multiple support agreements are covered in the text. You can read that. The joint return test, again, that sounds like the same thing because it is. Dependent must not file a joint return unless it's only claim a refund of taxes. And lastly, must meet the citizenship, I can't say anything, that same test that we discussed under qualifying child. There can be tiebreakers, which means that more than one person might be able to claim an individual as a dependent. So A qualifying child test gets priority over qualifying relative. So if someone can claim them as a qualifying child, that gets priority over qualifying relative. Parents generally beat non-parents. And in a situation where it's two parents, so it's all the same for qualifying child, it's both parents, then it's the highest AGI wins. So the taxpayer with the highest AGI is going to win that battle in the tiebreaker, which I don't know whether that's fair or not. Now, if you're in a divorce relationship, you can actually have an agreement whereby you agree that one person or the other person gets it legally. And then the tiebreaker wouldn't come into play because you've already made a decision as to who gets it. Oh, here it is. You can override that with a contractual agreement.